Hello, everybody. Chapter 3 is about taxes. And if you've read Chapter 3, I hope you have, you're going, oh my God, this is a lot of stuff. And yeah, the good news, no, there is no good news. It's that bad. Government does not make things simple. The IRS does not make things simple. I'm going to do my best to boil it down. Let me pull up the other screen. Okay. So at the end of the year, you're going to get documents in the mail and they will report your income. From if you have a primary job where you're an employee, you will receive a W-2 that details out how much money you made and how much they withheld for taxes. You may also get 1099s. I skipped one. There's a 1099 with no suffix, just a 1099. That is if you did some work, substantial amount of work for somebody, but you're not an employee. So for example, maybe you did landscaping for somebody and they paid you $1,000. You're not an employee, but they need to recognize that they paid you money. So they're going to send you a 1099. Summer ago, I built a bunch of custom furniture for a business in town. It was the total bill, I think, was like $3,000. I'm not their employee, but they wanted to record it as a business expense because they bought these assets. So they sent me a 1099. You will also get a 1099 for interest that you've earned on savings accounts. And you will get a 1099 DIV for dividends. So if you own stock and the stock has paid dividends, or if you own a mutual fund and stocks within that mutual fund have paid dividends, you get a 1099 DIV. There's a bunch of other forms of 1099s, but I'm not going to go into them. I'm going to try to keep this conversation at what you might be encountering now and what you would normally encounter after you graduate in your first couple years of your new job before your life gets complicated. Understand, as your life gets more complicated and you have more investments and you have children, or you're running a business on the side, or you're running a business full-time, taxes will get exponentially more complicated. At that point, you probably need some help. So right now, I'm going to keep it to the basics that as long as your financial life is not complicated, you can handle it yourself. Okay, filing status. You have three choices. You can say, look, I'm a single person filing my taxes for me, myself, and I, all by myself. Second, if you're married, you can file jointly, which means you're going to combine all of the income of you and your spouse and send in one tax document for the two of you, your household. Another option is to be married filing separately. So you're married, but you're going to file a return and your spouse is going to file their own separate return. There's some unusual cases where that's beneficial, but typically, if you're married, you're going to file jointly. I've only filed two different ways: single before I was married, and married filed jointly once I was married. Whoops, sorry. Okay, so I have a lot of information on this page, but I also think it's about the simplest summary I can come up with. If you follow along in the book, you'll see the same sequence in the book. When you file your income taxes, you're going to use a 1040 or a 1040EZ, are the standard tax forms. Those forms are going to start out with, what is your gross income? That is the sum of your salary that you got on your W-2, your 1099s for interest, dividends, and whatever else, any capital gains you have. So if you bought a stock and then sold it for a profit, or you bought a house and sold it, and the house isn't a good example. Maybe you bought an investment property and then you sold it for a profit, you'd have capital gains. And also income if you are retired and you have a 401k and you're pulling money out of that fund, then that could be treated as income as well. From gross income, you have adjustments. So this is right off the top. Let's subtract some money from our income from student loan interest, IRA contributions. We'll talk about that in more detail, or contributions to health savings accounts, which we'll also talk about when we get to the health insurance portion of the class. Gross income minus adjustments gets us to adjusted gross income, AGI, which is a term that you'll hear tossed around quite a bit. After adjusted gross income, historically, there would be exemptions, which means you get to subtract a dollar amount for each person in your household. For you, your spouse, your children, and there's just a flat amount. Take $2,000 per person, and we're going to subtract that. I have that crossed out because that is gone. You probably heard some rumblings in 2018. There was a major overhaul of the tax system. One of the things it did was to eliminate exemptions. Now that may sound bad, but hold on. After you have adjusted gross income, you get to subtract the higher of two options. The first option is a standard deduction, which means if you're single, filing as single person, you can subtract $12,400 from your adjusted gross income. If you're married, you can subtract $24,800. Or you can itemize deductions. Itemized deductions would include mortgage interest, property taxes paid, state income tax, charitable contributions, and medical expenses if you had a lot of medical expenses. The medical expenses have to be 7.5%, greater than 7.5% of your adjusted gross income. So that's not normal. That's you had something bad happen. If you add up all of these itemized deductions and they are greater than the standard deduction, then you can use that greater amount. So let's say you're filing single, you add all of these up and you have $14,000. Then you would use this list of itemized deductions for $14,000 and forget about the standard deduction. Okay, so you pick the higher of those two options. Now, what's the upside of exemptions being gone? When they eliminated these exemptions, they doubled the standard deduction from what it used to be. So these amounts here are double what they used to be. For most of us, that's a good thing. For me, it was a good thing. Itemizing deductions is complicated. Coming up with all of the documentation and adding it up and trying to figure out what qualifies and what doesn't. And you have to go through all of this work just to see what the number is and then decide whether it's better to take the standard deduction or the itemized deduction. Was a major headache. One of the major complications of doing your taxes. Now, because these standard deductions are so high, most people don't itemize anymore. I may, until they change the tax code, which they will. But for now, I don't even think about itemizing, because if I add all of these things up, they will not come close to 24,800. So that has greatly simplified my preparation of taxes, and it should for you as well. Okay, adjusted gross income minus your deductions, standard or itemized, gets you to taxable income. Oops. Now we're going to go to the tax tables, and there's form for it, and it'll say if your taxable income is between this and this is how much tax you owe. And I'll talk a little bit more about the tax tables in another video. So let's say you had taxable income of $25,000. You go to the chart, it says, okay, you owe $2,500 in taxes. Next step is there are some tax credits. You get these tax credits, you get to subtract from the amount of taxes you owe. Tax credits include child tax credit, $2,000 per child. Lifetime learning credit. So if you are paying tuition, you get to deduct some of that tuition. And that applies to individuals. It also applies if you're paying tuition for children. Earned income tax credit. This is a special program where if you are working, but you don't make a lot of money, and if you have dependents in addition, they're going to reduce the amount of taxes you have to pay. And then lastly, there is a credit for childcare expenses and also expenses for caring for another dependent. So if you, are, for example, are taking care of your 90-year-old grandparent and have expenses, you can get a tax credit for that. So taxes owed minus tax credits gets us to taxes owed final. This taxes owed preliminary and taxes owed final, those aren't terms used on the tax forms. Those aren't terms anybody else uses. I just put them in there because I needed to differentiate between taxes owed before tax credits and taxes owed after tax credits. So now in your tax form, you have figured out how much you owe. Say it's $2,300. Then you're going to compare that to how much money was withheld from your paycheck by your employer. And if not enough has been held, you owe $2,300, they've withheld $2,100, then you need to write a check to the IRS for $200 difference. If they've withheld more than that, so you owe $2,300, they've withheld $3,000, then when you turn in your tax form, the IRS is going to issue you a refund of $700 of the excess amount that you've paid in. You probably hear a lot about people getting excited about, I'm getting a big tax refund. It's like money found. That's wrong. I'm going to tell you, that's not smart. Because if you have overpaid your taxes through the year, so at the end of the year, they owe you a $700 refund. What's happened is you've just given the government a $700 interest-free loan. You've been letting the government use your $700 over the course of the year. Why? Do you like helping the government out? Like providing charity? I don't think so. What you really want to do is get as close as possible to what you're actually going to owe, so that when you get to the end of the year, your difference is pretty small. You know, if you are plus or minus $200, $300, you've done fine. So if you're getting a small refund, or if you have to write a check for a couple $100, you're okay. That's what you want to target. You don't want to be receiving a large refund. If you are, you need to go back to your W-4, which determines how much is withheld from your paycheck, and make adjustments there so that they're not withholding so much. Your paychecks every 2 weeks are going to be larger. And then when you get to the end of the year, yeah, you won't have as much of a refund, but you've had that additional money throughout the year. Okay, one last page in this video. I want you to understand the difference between a tax deduction and a tax credit. Pop back here. Tax deductions are here in the form. Whoops, this section of the form. Tax credits are down here. Here's the difference. Let's say you have tax deduction. So I have income of $25,000. I get to deduct $2,000 for some itemized deduction. That reduces my taxable income. Then I figure out how much taxes I owe, and I come up with $3,450. The way a tax credit works is you made $25,000. A tax credit is not a deduction. You figure out how much money you owe, $3,750. Then a tax credit reduces the amount of taxes you owe. So here my taxes owed goes from $3,750 minus this tax credit to $1,750. So you see the difference here? A tax deduction, what happens is you're going to save whatever your tax rate is times that deduction. So you're saving 15% of $2,000. That's a deduction. A tax credit, you're saving $2,000. Tax credit comes off of your tax bill after you've figured out your tax bill. So a tax credit is way more beneficial than a tax deduction. Okay, there's going to be more tax talk to come. We'll stop this one here.